Hello everyone, welcome to UPSC Economics by Rohit Lal. So in today's video, let us understand the three terminologies of financial market and its component money and capital market. Now this is a concept, or these are terminologies in the broad topic of financial markets, which is a very important topic from the examinations perspective. So let's get started and understand at a basic level what is meant by financial market. So financial market is essentially a market which is allowing entities which have surplus funds and want to lend that money to entities who want to borrow money for different purposes. For example, let's say there is Reliance Industries and Reliance wants to undertake research and development for a new product it wants to launch in the market. So Reliance Industries could approach the financial market to meet its fund requirements. So basically financial market is a market which is allowing entities to borrow and lend for different objectives they might have. Now the financial market can broadly be divided into two components, which are the money market and the capital market. Now let us understand what are the differences between these two broad components. So if you talk about money market, so money market is a component of the financial market which enables entities for short-term borrowing and lending. So it is a component which allows entities to borrow and lend for 1 year so that they can meet their operational or working capital requirements. For example, we know that the government gets tax revenues on a periodic interval. However, the government needs to incur expenditure on a daily basis. So for example, you could have the government which has to pay fuel subsidies to the oil marketing companies, and it anticipates a certain amount of cash shortfall right now because it knows that it's going to get tax revenue sometimes in the future. So the government could approach the money market and meet its short-term borrowing requirements. Now the key thing or the key feature about money market is that it is characterized by high level of liquidity. Because money market is essentially a market which is enabling short-term borrowing and lending, so the different instruments which are used in the money market can easily be converted for cash if the lender so desires. So because these instruments can easily be converted for cash, the money market is characterized by a very high level of liquidity. The other important thing to remember about money market is that the borrowing which entities take in the money market, for that they may or may not have to provide some form of security or collateral. So basically borrowings in money market may or may not require some form of collateral. The last important thing to remember about money market is that it is the Reserve Bank of India which regulates the money market. So it is RBI which regulates the money market. The second broad component of financial market is the capital market. Now capital market is the market which is enabling entities to borrow and lend for long term. So if any entity wishes to borrow and lend for more than 1 year, then they can approach the capital market. Let's say you have a corporate which wants to undertake some form of merger and acquisition, or basically it wants to acquire another company. So that corporate, if it wants to borrow funds because it wants to borrow for the long term, can approach the capital market. Now the thing to remember about capital market is that entities can borrow via two broad mechanisms. So you could have a company which raises funds by giving ownership to the investors in the company for which it is borrowing. So you could have companies who issue share in order to raise funds from the market, and that is called equity form of borrowing. On the other hand, you could have government and you could have corporates which issue bonds and debentures and they borrow money via these two instruments, and that is called as debt form of borrowing. So under equity form of borrowing, what happens is that the investor becomes a partial owner in the company and the company is not obligated to pay back that money. However, under debt form of borrowing, which is via bonds and debentures, the company or the entity which is borrowing needs to pay periodic interest, and it also needs to pay back the principal or the loan amount eventually. Now, in the capital market, which is the market for long-term borrowing, it is the Securities and Exchange Board of India, that is SEBI, which regulates the capital market. So these were the key differences between the money and the capital market. I hope you did like this video, and if you did like this video, do check out the other videos on this playlist. Thank you once again for watching.